hello to one of the last handful of Michigan time starting seminars. Right? It's going to be a whole change of life for all of us come May, when we actually have to be places on time. Okay. So today, this is we're all anticipating learning how much we missed getting tremendously rich in the last few months from Lynette Shaw. Lynette Shaw right here, our speaker, studied physics and sociology at the University of Texas at Austin as an undergraduate. Took some horns. And then she received her master's and PhD degrees from the University of Washington in Seattle in sociology. And she is interested in the complex systems perspective on the evolution of, let's say, the evolution of culture. And then we can ask them, what is culture? That's what I asked. and maybe you can define culture as a shared set of values. We're a member of a culture if we share certain values. And then Bitcoin sounds like finance, but actually it's a culture because it's something that's valued for no really good reason other than, well, we'll find out. Now, Lynette came after her PhD. We hired her as a postdoc in the Center for the Study of Nonlinear, the Center for the Study of Complex Systems in 2016, and then last year she joined us as a postdoctoral assistant professor together with the Michigan Society of Fellows. So she's here this year and here hopefully for a couple more years with us. Okay, let's learn about Bitcoin.
So is this working? Is this thing on? Great. Okay, well, today, as hopefully you know, I will be presenting on what is a Bitcoin worth. So what is a Bitcoin worth? Well, as of a couple of hours ago, it's about 11,500 for a Bitcoin. And I'll admit I wanted to be cheeky and just end the talk right here. But given that we have this space for an hour and a half, I thought I'd go ahead and get a bit more of a nuanced analysis. So here I've got the Bitcoin's exchange rate from the end of May 2013 up until about a week ago. So if you got into Bitcoin early, either by buying it or actually mining it maybe as a fun side hobby prior to the middle of 2013, today's price is probably going to make you pretty happy. The exception to this, of course, is if you were one of those many people, unfortunate people, who got in early, but then lost the piece of paper or hard drive that had access to the wallet where all your Bitcoins are kept, and you will never have it again, in which case today's price is actually pretty painful. So if you were part of this long, slow build of adoption between 2014 to late 2017 and decided to stick with Bitcoin through all those intermediate ups and downs that it experienced, you're also probably pretty stoked. If, however, you were one of the many who got into Bitcoin this past December, right when it was hitting its all-time high of near $19,000 a Bitcoin, today's price is probably not so happy for you either. Now, if you're like the vast majority of humanity and you have not gotten into cryptocurrency yet or bought into Bitcoin, and maybe even if you have, today's price might actually be eliciting this sort of reaction. So if you've been asking yourself some version of this question, you should know that you're not alone. In point of fact, not just for the general public, but for academics and experts alike, the rise of digital currency has brought with it a ton of really important but complicated questions. So there's the obvious technical questions of what even is a Bitcoin, cryptocurrency, the blockchain. But a lot more pressing to many people, and the one I'm going to be focusing on today, is how and why is Bitcoin or cryptocurrency worth so much now? More specifically, this talk will be focusing on a more academic rephrasing of that, which is what does the rise of digital currency tell us about the social processes underlying economic value? So toward that end, I'm going to be structuring this talk in 3 parts. The first one is going to be a very brief introduction to Bitcoin. If anybody has any more technical questions after this introduction, I'm happy to get to them in the Q&A. From then, though, I'm going to be moving into first a theoretical portion, where I'm going to be talking about how taking a computational modeling approach might actually shed some light, give us some understanding of how these processes of social valuation work. Then I'm going to be moving into what is going to be the bulk of the talk, which is going to be a lot more empirical in nature. And I'm going to be talking specifically about how over the course of Bitcoin's adoption and valuation, different people have defined Bitcoin differently. And this has actually been very fundamental for it getting to its current moment of success and looking at indications of what it means for its future. Okay, so a very, very brief introduction to Bitcoin. So Bitcoin can be described as an electronic peer-to-peer cash system that's based on a cryptographically secured distributed ledger. This is the so-called blockchain. Importantly, the Bitcoin system is not localized on any single computer in the world, but is instead spread across a decentralized network of computers or so-called nodes. On every node, there's a copy of the record of every single Bitcoin transaction that has ever happened. And in addition to storing copies of these records, these nodes are also competing in real time to verify new transactions as they come up and add them to the official record. This is the process that's known as mining. One more thing to note about this record is that all of these transactions are anonymized in as far as they don't conclude any individual's names or identifying information, just the addresses of wallets themselves. So Bitcoin is also based on open source code. And that code, since it was first released in a white paper, first proposed in a white paper at the end of 2008, has been the basis of the development of hundreds of other digital currencies. These are so-called altcoins, and the development of many decentralized applications that are built using blockchain technology. So that speaks to a technical definition. Now, just to give you some scope of how its value has changed through time. So the initial exchange rate of Bitcoin was posted at just 0.1 cent a Bitcoin back in 2009. From there, it has now reached its all-time high to date of over $19,000 a Bitcoin. That's this past December. The current market capitalization for Bitcoin alone is $100 billion over that. And for all cryptocurrencies combined is over $400 billion. So there's a lot of money wrapped up in it.
Is that 100 billion market cap based on 19,000 or 11 current?
The current, well, it's a little bit higher because I pulled that last week when it was 10,000. So yeah, but it's the current marketable capitalization, yeah. In addition to this market capitalization, there's also to date been billions of dollars of venture capital funding that has been invested into digital currencies and blockchain technology. So this question of why and how it has managed to gain so much worth is the big question of interest to a lot of folks today, and it's what I'm going to be focusing on in this talk. Okay. So getting into this theoretical portion. The rise of digital currency has brought into the forefront a subject that tends to be pretty taken for granted or in the back of our collective awareness, and that is the question of where does economic value actually come from? So in this part of the talk, I'm going to be just showing you some results from a computational model I've developed, an agent-based model, to help that I'm going to argue will help us think through this issue a little bit further. So unlike other forms of money, Bitcoin is not backed by any real-world commodity or government or state. Nonetheless, it's been seeing these huge gains in value. This has actually led to a major division in opinion over whether Bitcoin's value is actually just one long big bubble that is doomed to pop one day because it's not backed by anything that has any intrinsic worth, or if it is instead people's confidence or treatment of it as if it has worth that gives not only digital currency, but money more generally its stability. So we can articulate these just to typify these approach. On the left here, I have a quote from none other than Paul Krugman in a blog post to the New York Times opinion pages back from 2013 entitled "Bitcoin is Evil." So he states, to be successful, money must be both a medium of exchange and a reasonably stable store of value. And it remains completely unclear why Bitcoin should be a stable store of value.
Okay, last question I can reserve. Is he talking about fiat currencies? Because I think that's what Group was talking about.
Sure, he's just talking about there's nothing backing Bitcoin, so it can't have a stable store of value. Right. So can be contrasted against, however, another sentiment expressed in this Wired article from this past summer entitled, "Yes, Bitcoin has no intrinsic value, but neither does the $1 bill." So in truth, almost nothing in the world of trading and money has intrinsic value. Money has only the value that is ascribed to it over time. So we can actually think of these two camps as falling into the irrational bubble view of digital currency's value versus a social conventionalist approach to it. Interestingly, these differences actually map on very well to a bigger historic divide that has long existed between more economic and more sociological models of value, which has been described by some as the difference between a realist or realism approach to value and a constructionist or constructionism approach to value. So getting into those a little bit more. So the realism or objective subjective school of thought of value essentially is asserting that there is such a thing as an intrinsic or fundamental value to things. So this goes all the way back to classical models in economics, such as the labor theory of value, where the labor that is put into a thing gives it its value. But it's also present in neoclassical models, which are the prevalent ones today, wherein there are subjective atomized personal preferences I have, those interact with the objective availability of stuff out in the world, and from that we get value. Importantly, it's also the fundamental assumption underlying the efficient market hypothesis. So the efficient market hypothesis is the one that states that if you allow a market to efficiently operate, it will eventually settle on a price for a product that reflects its true underlying value. So in more contemporary models, we've also incorporated the possibility of there being noisy signals in that process of evaluating an object's intrinsic value. So the classic example here is that of a used car. So I go out, I'm in the market for a used car. It has some underlying qualities that do or do not match up with my personal utility. I can't actually directly assess that quality, but I can do things like go kick the tires, look under the hood, et cetera, to try and assess its value. So we can contrast this school of thought against the more sociological approach to value. So this is frequently found in sociological research or sociological type research that emphasizes the primacy of social construction processes. So social construction can be summed up pretty well, the so-called Thomas theorem. This states that if men define situations as real, they are real in their consequences. In this case, we can think of this as essentially asserting that if everybody collectively thinks that a thing has value, then for all intents and purposes, it has that level of value. This is very relevant to models dealing with cumulative advantage, especially in the market for cultural products, for instance, when you're pricing a painting, and also models of status. So you can argue that the price I'm willing to pay for a Louis Vuitton bag is not so much about the intrinsic utility that comes to it, but because I know everybody else will pay a lot for it. So its value comes from the fact that everybody else values it so highly. So it might look like these models exist in fundamentally different worlds. But the work I'm going to be honing in on today, or the work I'm going to be presenting today, hones in on some common ground that they share and see if we might find a way of putting them in dialogue by virtue of that common ground. So specifically what I'm going to be focusing on is the similarities that both these types of models have when it comes to the actual process of valuation itself. So in a nutshell, what they both contain in them this notion of individuals who come into a situation unsure initially of the value of an object. From there, they then take in information about that object, that is to say they learn. And from there, they come up with an estimate for what the object's value is. So that's the process of valuation as learning. So given that common point of ground then, I'm then going to contend that the primary difference between these two schools of thought is ultimately what the source of information is in that valuation process. So giving you a schematic. So here we've got at the center valuation, which is basically just a process of individual learning under initial uncertainty. In our more economics approaches to valuation, we conceive of that information coming from non-social sources. So it comes from the used car itself. This is opposed to the sociological approach to valuation, wherein I go out, I'm trying to assess the quality of, say, a hat, but I'm not so much concerned with the intrinsic utility of the hat, but what I think other people might think the hat is worth, whether or not it's cool. Importantly, though, in that process of coming up with my own estimation for the value of a thing, I'm now giving off information that other people are going to be using in their assessment of its value. And that's going to be a key feedback loop that's going to be very important for describing the difference between social versus non-social valuation processes. And then, of course, we have real life, which is going to be a combined scenario.
So, yeah, I'm not much of an economist, but could you say, could you clarify, if I say it's non-social value like a car,
Yep.
aren't I competing with other people for that car, and so the price depends on what other people think?
So this is the notion of, so this is an important distinction right now. So I'm trying to step back to the notion of where value comes from. Prices are a dynamic which set on top of value. Does that make sense? So there's valuation which occurs, like there's the nature of value, and then prices play out on top of that. Does that make sense?
Okay, I'm not
Yeah.
sure how to distinguish the two.
Yeah, so this is a big question. So this is a big question in economics, is like, what's the difference between price and value? So when you get to the more social constructionist argument, there might not be a difference, but there is such a thing in economics as mispricing a thing. So does that make sense? Okay, so, all right. Supply, that's the supply and demand. Yeah, so I'm not talking about supply and demand right now. I'm talking about valuation itself. So where does value come from? Does that make sense?
I think, just to help, I think like isn't value more like from a personal standpoint, but price will be decided by the marketplace?
Yes, so the price is the coordination given everybody else's individual utility, whereas the individual utility here is where value is located. Does that make sense? We'll come back to this. Okay, cool. Okay, I'm happy to expound upon this in the Q&A. Cool. All right, so right, in real life, we probably often have a combination of these two. So this is going to be our conceptual setup. Now we're going to need to implement this into a relatively straightforward computational model to see what that can do to potentially clarify our thinking about these dynamics. So the basic gist of how we're going to implement this model of learning and valuation is to begin by thinking of an object's value as essentially being this unknown parameter, we'll call it theta, that we're trying to estimate based on the data or information that we have flowing in. So for those who are less familiar with statistics, we can think about this as estimating the average height of a population that we can't directly go observe, but we can take a sample of people, measure their heights, and then infer from that. We're going to so with that setup, we can then get at individual learning in this computational model by having individual agents present who are in the system that are using a basic process of Bayesian updating to estimate the value of the object. So agents will start with an uninformed, uncertain model of a thing's value. They will go out, they will gather information, update that value, and repeat. So importantly, in the social case, we're going to need to allow agents to act in a way that on any given term reflects their current estimate of theta. This is what's going to be able to produce that social information that is needed for that social valuation process. So specifically in this model, if a learning agent has a current estimate of theta as being 0.8, that means in that turn they'll have an 80% chance of being in an up state, which is just a generic signal in that turn of interaction that says to the other agents that that agent likes or values a thing, okay? So I'm actually anticipating that the audience today is coming from a wide variety of backgrounds, so in the interest of that and time, I'm going to right now skip over the slides where I get into the nitty-gritty of the formalization of this, but I do have those available for the Q&A, so if anybody wants to nerd out with me about that, I'm totally happy to do that, okay? So given that setup then, we're going to then look at different conditions, different informational conditions which are going to reflect our various scenarios. So I'm not going to have time today to go into the mixed scenario, but you actually get a lot of counterintuitive results from that one. What I'll be focusing on instead then is on the pure non-social scenario and the pure social scenario, which are going to reflect the realism versus constructionism ideas of valuation respectively. So in the pure non-social systems, agents do not observe other learning agents. They only observe fixed agents who are not changing throughout that course of interaction. They're going to have their own theta fix, which they all share, and they're going to be emitting signals in accordance with that. So this is going to be like interacting directly with the object you're trying to evaluate. So going out and kicking the tires of the car, looking under the hood, etc. Counterpose this then against the pure social situation, which is going to get at our constructionist or intersubjective value scenario. Here, there's actually not going to be a true theta fixed defined. There's going to be the object that's being evaluated is not going to have some underlying quality or intrinsic value. Instead, we're just going to have a bunch of actors who are all looking at each other, trying to figure out how much they think everybody else thinks this thing is worth. Is that clear? Ish. It's easier when you implement it computationally. All right. So there's a lot of scenarios that you can explore. This is one of the benefits of doing a computational approach. I'm not going to be able to go through all of them today. There is one that I've got preliminary work dealing with what happens when bubbles and panics occur on top of conventional value. I can talk about that later if anybody's particularly interested in that. But today I'm going to be focusing just on baseline findings and a couple of substantively interesting ones that have some bearing on the case of digital currency. Okay. So what do we get? So these are examples of two runs, different scenarios on either side. So I've got the pure non-social scenario on the left, pure social on the right. On the x-axis, we have time. That top pane is indicating the average theta. So this is the collective estimate, the average estimate of what theta should be in that group of agents. And on the bottom, we show the proportion of agents on any given turn who are in the up state. So the main thing we're interested in today with regard to digital currency is whether in the absence of a true theta fix, a true value for that they're estimating, if we can arrive at a stable collective valuation of what an object is worth. So here with the non-social, as expected, we find that the systems of learning agents do stabilize on an average estimate of theta. That's where that horizontal line coming up. And that they also correctly do find the true value of theta fix. So their average estimate is 0.2005. The true value is 0.2. Right? In the pure social run, however, we also find that same stabilization, even though there is no fundamentally correct theta fix to find initially. Instead, what is happening is that the social system is essentially falling into a self-reinforcing convention about what the value of theta is. So in this case, they fall into the convention that theta is about 0.6, and then they self-reinforce it. We can get at that a little bit more systematically by looking at how trends, how things behave across a couple of hundred runs under each condition. If you're not familiar with box and whisker plots, along this vertical line is a distribution of how long individual runs took to converge, with most falling within the box in that vertical line. The different colors are just representing then the different sample sizes agents were using in their learning process. The big takeaway from these results is that all the pure social or pure constructionist systems readily converge and stabilize on a timescale that's comparable to our non-social and pure realist scenarios. So they take a little bit longer, but not dramatically longer to stabilize on a value. So in addition to seeing where the pure social runs do converge, we can also look at what average estimate of theta they collectively converge upon across runs. So on the x-axis here, we have the average expected value that theta in those social systems came up with, that convention they ended up landing on. And on the y-axis is just the number of runs who ended up there. So that's a histogram, right? So unlike the pure realist systems, which always converge on the correct value of theta, what we find is that across runs, there's actually a lot of variance in what the agents come up with. So they tend to be grouped in the middle around 0.5, which is where is the uncertain guess that all of these systems begin with. So that's not surprising. But we do find a spread on individual systems that some of them ended up with a value convention all the way out to 0.3 or all the way up to 0.7. What this is all suggesting is that there tends to be a lot of contingency or path dependency when it comes to social valuation processes. And that's really interesting to find because it jives extremely well with a huge body of qualitative research that has been done on collective valuation processes. Because we're using a computational approach now, we can more systematically dig into this contingency a little deeper in order to explore how sensitive our pure social or constructionist scenario is to initial conditions. So in all of these, all the agents start out with that same complete uncertainty as they did before. But this time, because I get to play God in these simulations, I can force a certain proportion to start that first round of interaction in the upstate. I can basically make it look as if at the beginning that a lot of people really do or do not value a thing. After I do that, though, I let go and just do the same learning process as before. So you see that initial place that I forced them to be on the bottom axis, and on the y-axis is where that system ended up converging. What this all is showing us is that these constructionist processes are extremely sensitive to initial conditions. So just that first starting state was enough to drive where they collectively ended up in their estimate of what something was worth. Specifically, I'm going to say that purely social systems tend to pick up early accidents on valuation, and then they run with them and reify them. And over time, that accidental structure becomes real structure. Okay? So a final scenario that I'm just going to briefly mention that this computational model helps us explore is what happens when not everybody begins in a completely uncertain state. But there are instead people, one or a few agents who are present at the beginning who are really convinced that everybody really highly values something. So in this case, I'm doing that with agents who begin with a very strong prior that everybody values this thing, theta to be 0.9, okay? So I want to note that these actors are technically wrong. These actors are technically wrong at the beginning of the simulation in as much as they are incorrect in assuming that most people have ascribed that high a value of theta. So they're not correct when they start. And so these graphs are similar to that histogram I showed earlier. That red vertical line is where that former histogram was centered. What we can see in these results is that it turns out in these systems having even just one single actor who is really certain initially about what the value of a thing should be can actually affect where the eventual conventional value of it ends up. So can't necessarily force it all the way to 0.9, but it will systematically shift how much that collective system considers something to be worth.
So everybody else except the one started at 0.5?
Yes, everybody else in that system started with a flat prior. That was uninformed. They had a flat prior. Their best guess was 0.5, but they were not very sure about it. Just one agent with a lot of conviction or being very convinced was enough to shift the whole systems where it converged. Cool. All right. So as mentioned, there's a bunch of additional things you can explore using a computational approach, but I'm going to go ahead and wrap up this theoretical portion of the talk and go dive into the more empirical portion if that's all right with everybody else. Okay. I will talk about agent-based modeling all day, but okay. All right. So far, I've been talking at a very abstract level about these models of value that individuals have in a very highly idealized situation. It's very important to ask, though, that where do these ideas about what a thing's value is come from in practice? Okay. Specifically, in this case, we can ask, how is it that individuals came up with the notion that cryptocurrency has worth either to themselves or others in the first place? So for insight into this, I'm actually going to turn to a body of very well-established findings from areas like organizational studies and economic sociology that have strongly confirmed that in economic valuation depends on or arises from categorization. So what I'm basically saying with this is how we define something is going to drive how we ascribe worth to it. So I'm going to give a little toy example here. So if we were all to collectively define or categorize this platform in front of me as being a chair, we're probably not going to assign a lot of value to it because it's not doing a very good job of being a thing you could sit on, right? That said, if we define it as a podium, it's actually doing a lot better job performing those functions in that it's holding up my stuff, presumably looking very stylish and impressive to you all. It actually even has a cup holder. So given all these attributes, right, if we define it as a podium, I'm actually likely to consider it to have a lot more worth, to evaluate it as having a higher economic value. Okay? Please don't pay a lot of this for a chair, right? So this is a bit of a toy example, right? But for cryptocurrency, this question of definition has been a very big issue, and it continues to be one. I offered a technical description earlier, but there's still a lot of ambiguity around Bitcoin, what it represents socially or politically or economically. So is it a politically revolutionary money? Is it more like a criminal currency or an investment commodity? Is it the future of online payments, or should it really be thought of as just a technology that's useful for business and financial applications? So what I'm going to contend today is that at various times and to various people, it has managed to be all of these things. Furthermore, what I'm going to be arguing is that this definitional ambiguity, or this ability to be many things to different people, what's sometimes referred to as a quality of multivocality, is actually what has allowed digital currency to reach its current level of success. I'll also be asserting, however, that digital currency is now reaching a phase where this multifacetedness in its identity is currently under a lot of pressure to start narrowing down and presenting some evidence of where it looks like that process might be headed. Toward that end, I'm going to be using a mixture of qualitative evidence from the documented history of Bitcoin, as well as some other metrics reflecting venture capital funding and automated content analysis, actually, of trends and media coverage. Okay. So this is a slide with too much information on it. But I just wanted to give you a very high-level overview of the history I'm about to step through right now. So just as a caveat, one could spend a whole presentation, maybe even an entire dissertation, given the right discipline, on any one of these phases. What I'm just going to be offering, though, is a very high-level summary of these different phases in adoption, so you can get a sense of the different constituencies and identities that have been involved and at play with cryptocurrency's ascent. So Bitcoin emerged originally as an explicitly ideologically driven project. It grew out of an online community of so-called techno-libertarians and cypherpunks who were specifically interested in developing a type of anonymous electronic cash that could allow individuals to conduct digital transactions outside the monitoring and control of governments or central financial institutions. Many of the people involved in these groups also had very anti-central bank or anti-Federal Reserve System stances, and specifically wanted a form of digital currency that could emulate gold with respect to features such as having an inherently limited supply. So when Bitcoin was first introduced, it was directly in response to these groups' desire to create a subversive digital money that could be an alternative to fiat currencies. So a strong reflection of these political origins can actually be seen here in the code from the Genesis block. So this is the code that was used to mine the very first Bitcoin ever. So highlighted, I have here is a section in the comments of that code with the previous day's headline about one of the big bank bailouts that occurred at the beginning of the Great Recession. So very much a political statement in there, and it's one I'm going to come back to in a bit. So, as mentioned earlier, Bitcoin and the subsequent cryptocurrencies that have spun off from it have been based on open source code. And as you might imagine, there was a good degree of overlap between the techno-libertarian communities and the cypherpunk communities with the larger open source and tech community. Okay. It was this overlap that was actually a critical bridge early on for Bitcoin to let it spread beyond that very narrow, politically radical context it started out in, out to a wider audience who wasn't necessarily interested in it as much because it was a subversive money, but did find it to be a really innovative and interesting project that they enjoyed working on and could participate in, at some point make some spare money at. So just to give you some sense of the timing for this phase, the first Bitcoin was mined in January 2009. I don't know what happened. All right. So the first Bitcoin was mined in January 2009. It was mostly worked on at that time by a small group of people who were pretty ideologically devoted to the project. By 2010, however, the interest in it had managed to diffuse out into the wider open source and computer hobbyist community to a level that was actually briefly featured in a couple of important tech news sources such as InfoWorld and Slashdot, which only further accelerated its spread. Today, the main Bitcoin project is actually still housed on the open source collaboration website GitHub. It has over 14,000 commits. And at this point, hundreds, if not thousands, of individuals have either contributed to the main Bitcoin project or to other cryptocurrency projects. Okay. So the political and open source community roots of Bitcoin were actually essential to get it off the ground and running before it had a lot of economic value. So people were basically participating in it because they had this value rationality. They just believed in the project or thought it was cool. It wasn't, arguably, we didn't actually see people starting to adopt it for purely instrumental reasons until it started becoming a de facto currency for illicit online activities. So specifically critical to this transition was one person, Ross Ulbricht, who was the creator of the darknet black market Silk Road. He was actually an early participant in those techno-libertarian circles, and that's how he first became aware of Bitcoin. He chose to use it for Silk Road specifically because of the anonymity allowed in transactions. So since that time, it's exploded in usage for lots of illicit and legally gray area online activities, including everything from gambling, ransom and extortion, money laundering, weapons, etc. It's also been the basis of a huge number of scams, which hopefully none of you were part of, and the subject of also a lot of fraud. It's a really uncomfortable aspect of its identity for many groups that are now seeking to mainstream and legitimate cryptocurrency, and it actually led to a lot of initiatives within the Bitcoin and cryptocurrency communities to proactively work with law enforcement and regulatory bodies to try to reduce the amount of criminality in its use. Nonetheless, there's definitely an argument to be made that there's no way cryptocurrency could have gotten to its current point if it had not gone through this period of adoption and valuation for these purposes. So the potential then for Bitcoin as a speculative investment or a digital asset started becoming clear right at the same time it started hitting mainstream awareness. So in 2011 specifically, a rash of news coverage on Silk Road, which I just mentioned, brought Bitcoin to the broader public's awareness. That coverage is actually cited as being the cause of the so-called Great Bubble of 2011, where Bitcoin went from 86 cents a Bitcoin all the way up to the dizzying height of $30 a Bitcoin before crashing dramatically down to $2, which at that time led to another rash of articles proclaiming the death of Bitcoin. So here we are. So this volatility in price ended up drawing the interest of speculators from across the world. First in the form of a lot of casual individuals, investors who were coming from, a lot of whom were in Asia and China, who started flooding into the existing Bitcoin and cryptocurrency exchanges in the hope of making a quick profit. Soon thereafter, though, it actually started pulling in the attention of a lot more powerful establishment actors. And then probably the most prominent example in this regard is the Winklevoss twins of Facebook notoriety, who ended up getting involved in Bitcoin as early as 2013, and by 2015 have opened their own fully regulated cryptocurrency exchange called Gemini. Most recently, this part of its identity has been really strongly affirmed as of this past December 2017, when the Chicago Board Options Exchange and Chicago Mercantile Exchange started trading in Bitcoin futures. So this digital asset aspect of cryptocurrency's identity has been, continues to be developed and has been really important to establishing it in its capacity to act as a quote-unquote store of value, which many consider to be a really necessary requirement for Bitcoin to achieve its original vision of becoming a real form of money in its own right. However, for it to become an actual alternative form of money, it also needs to be a medium of exchange. And so it's in this respect that the ability of Bitcoin to become established as the basis of a global payment system has been really important to those who are still hoping to see some version of its original vision come to fruition. Excuse me. So cryptocurrencies actually do have some major potential advantages over existing systems like PayPal or Visa or banks when it comes to the digital transfer of economic value. So they're capable of faster confirmation times for large transfers of money or international transfers. They have the potential for lower per transaction fees, so that's been problematic recently. They also have the ability to handle nano payments, which are payments that are so small most payment processors don't want to have to deal with them right now. And also, importantly, they don't necessarily require the storing of sensitive customer information. It got some early traction in this regard in 2014 when Overstock.com, Dell, Expedia started accepting Bitcoin for payments. More recently, companies like Microsoft and Valve and Stripe, though that's changed recently, have started working with Bitcoin as well. Also really important in this arena has been the development of intermediaries like BitPay and Coinify, who go between people wanting to use digital currency and merchants who want to be able to accept it more easily, but also convert it into fiat as quickly as possible to protect themselves from price volatility. It's also, we've recently seen a lot of effort going into the development of something called the Lightning Network, which is a payment system that exists on top of Bitcoin. I can go into that more later if anybody's really interested in that. So, in these last respects, the development of Bitcoin as a basis for a global payment system has actually required some deviations from its original founding ideals. But on the whole, a lot of people consider this line of development to be really important and the best way forward for establishing digital currency as a real medium of exchange in its own right, which goes back to that original vision. However, as I'm going to be showing in the last part of the talk, most major recent interest in Bitcoin and cryptocurrency hasn't so much been focused in its ability to disrupt existing payment systems, but on how that technology underlying it might be used to improve the efficiency of existing business and financial applications. So, as previously described, the underlying design of digital currency relies on a secure distributed ledger. This is the so-called blockchain. And it turns out that the blockchain can be used for a lot of things beyond just keeping track of payments. It can be used for contracts, verifications, securities exchanges, and a whole bunch of other things that businesses and institutions have historically had to rely on third-party intermediaries to handle. So this development of blockchain technology applications is still relatively new, but we've already seen in the past couple of years an explosion in development and the founding of a huge number of startups, such to the point it's a running joke. There has also been a host of major corporations, like the one shown here, who have collectively sunk, at this point in time, hundreds of millions of dollars in money into seeing how the blockchain can be used to revolutionize their own applications and services. So notably, while many of these applications are proposed to be based on Bitcoin and its blockchain, there's also been the development of blockchains, a lot of growth going on with cryptocurrencies that are not, such as Ethereum, which are not trying to be money in their own right. They're more politically neutral. They're just trying to act as digital tokens that can be used for decentralized applications. So that definitional sort of distancing is about to become very relevant. So hopefully this relatively quick tour through Bitcoin's adoption trajectory has at least given you a sense of how multi-vocality has been very important for Bitcoin's adoption and valuation to date. But as some of you might already be anticipating, this multi-vocality comes with its own set of potential problems. And just to give a pretty glaring example of what those issues might be, I'd like to just point out how far we've come. So we started with the Genesis block quote about the bailout for big banks. And here I have the graphic now of a lot of the major corporations who've now bought into blockchain technology. You'll note the presence of many big banks. So the main point I'm just driving at with this example is that multi-vocality can be really important for getting something off the ground, getting it established as having an economic value, but it also can be a setup for major conflicts down the road. And that is the case that we're seeing right now when it comes to cryptocurrency. So as the fields and markets around cryptocurrency have started to mature in the past 2 years, there's been increasing external and internal pressures to start narrowing down this identity, to kind of decide what cryptocurrency is going to be and where, what its priorities are for future development. So we see this in terms of governments, for instance, trying to nail down the definition of digital currency so they can actually regulate it. As of right now, there's not a lot of consistency across governments on what it is. We can also see it on a more nebulous cultural level about how this continued ambiguity and lack of clarity of what cryptocurrency is has impeded the ability for the public to see it as actually legitimate. Also internally though, this is showing up. So the major example here is with regard to major decisions that the Bitcoin community is currently facing on how it's going to scale up its code to handle these current level of usage. And this has been an extremely contentious fight within the community. This is the so-called block size debate, which I do not have an opinion on in case anybody is wondering. So this leads to the question of how is this all going to resolve? Okay, so where is Bitcoin headed? What parts of its identity are going to be carried forward and which seem most likely to be left behind? So I'm going to assert right now that there are, of all those aspects I went through, there are currently 3 main contenders for Bitcoin's identity. That's that as an investment commodity, as a payment system, or as a technology for financial and business applications. So I'm also going to argue that those first 2 actually have a lot more resonance with that politically radical founding vision, in as much as they more directly relate to being a store of value and specifically a medium of exchange. In opposition, we have this third aspect, which is a lot more directly beneficial to what are arguably some of the same established systems and actors that Bitcoin originally wanted to challenge. So where is cryptocurrency headed? So obviously the future has yet to be written, but we do find some evidence right now that's pointing in a particular direction. So specifically here, I'm going to be looking at trends in venture capital funding for digital currency over the past 5 years and putting that in combination with information on the media coverage surrounding Bitcoin and cryptocurrency and looking at how that's evolved through time. And I'm going to be getting at that here with over 7,000 articles and posts that I scraped from 6 different news sources between May 2011 to April 2016. So when we look at this, what do we find? I'll leave you in suspense for a second. So from the venture capital funding alone, we actually have a very striking set of findings. So on the y-axis here, I've got total funding of for going into startups for each quarter in millions USD. In the red, I have startups that are focused on using cryptocurrency for payments. In the green are those startups that are more oriented toward the development of blockchain technology for financial and business applications. And the blue are the exchanges, which is kind of more directly supportive of that digital asset identity of Bitcoin. So you'll see from I don't know how to use the pointer on this, so I'm just going to gesture. So from mid-2012 through that next year, we actually see relatively little funding flowing into the digital currency space overall. In the last quarter of 2013, though, we see a sudden influx, that blue bar, into exchanges, and that actually coincides with a historic run-up in Bitcoin's price the last quarter of that year. I think that was the first time it broke 1,000. And then we see for most of that following year, so for 2014, payment-based startups and businesses are dominating when it comes to that. However, at the beginning of 2015, we see a very profound shift in the scale and priorities of the venture capital funding coming into the cryptocurrency space, with over 100 million just that quarter going into the development of financial and business applications. That next quarter, payments bounce back a little bit, but then for the rest of that year, drop off, and is ultimately dwarfed at the beginning of 2016 with another huge wave of investment into blockchain technology applications. So notably, especially from a organizational studies or economic valuation or economic sociology standpoint, this shift is associated with the entrance of a lot of big players from the existing finance and banking sectors into digital currency. So immediately following these shifts in venture capital funding, we also start seeing a big change in the coverage of Bitcoin. So in the last half of 2015 through the beginning of 2016, there was a huge new wave of coverage from a lot of high-profile publications. But that new attention was was increasingly dominated by a narrative that was starting to emphasize blockchain technology. And at that same time, we start seeing a fall off in conversations about cryptocurrency as being the basis of a new payment system that might disrupt current financial and banking systems. So giving you just a bit of that qualitative flavor of that. So this is from the cover story of The Economist in October 2015. This is the issue called The Trust Machine. So Bitcoin itself may never be more than a curiosity. However, blockchains have a host of other uses because they meet the need for a trustworthy record, something vital for transactions of every sort. So these trends in coverage are actually big enough that we can pick them up at the aggregate level using a technique called topic modeling. So for those of you who don't know, topic modeling is an unsupervised machine learning method that has proven really useful for extracting emergent themes or topics from these really large bodies of text. To give a very high-level description of what it does. So basically what topic modeling does is it goes into that giant corpus of text, looks for patterns in which words tend to co-occur together a lot, and extracts those really strong patterns and uses them to identify topics that are present in the corpus. Once it finds those topics, it can then go back and tag individual documents as being associated or belonging or containing that topic or theme. So when I run a topic model on this corpus, I get that I just described earlier. The algorithm ends up extracting 3 topics in particular that have a very strong bearing on the current question of interest right now, or with regard to Bitcoin's different identities, right? The topic model obviously comes up with more topics. If anybody wants to see those, I have that list earlier. So. Right, to explain how this works real quick, the algorithm is what's pulling up this list of words, and then I'm applying that label. So just to emphasize, I did not tell the algorithm to go find this list of words. It just found, for instance, that different documents tended to use the word blockchain, technology, ledger, distributed, et cetera, together a bunch, and it says, okay, this is a topic. So a major advantage of the specific type of topic modeling that I'm doing here, which is structural topic modeling, is that it allows me to go another step further beyond just extracting those topics and see how prevalent those topics have been through time. So this is what I get when I do that. So on the y-axis is the estimated proportion of the corpus that contains a given topic. On the x-axis is time, and that vertical line is indicating that quarter where we saw the major change in venture capital funding. So that's the beginning of 2015. So what we're finding here in this arena of collective discourse is a story that really reflects what we saw going on with venture capital funding. So early on, up through the early part of 2014, more of the corpus tended to talk about topics related to either payments or Bitcoin and cryptocurrency as a digital asset or investment. By mid-2014, that blockchain technology topic has begun to occur more frequently in media coverage. And by the end of that year, we're about evenly split in how often this corpus is covering those topics. The beginning of 2015, however, marks a major shift in the collective discourse. That coincides with both that sudden inundation of money into those financial and business applications of Bitcoin, and also that entrance of major players from the existing financial and banking industries into Bitcoin, right? So specifically what we start seeing is a notable decline with the prevalence of the topic related to payments, and a dramatic uptick in the frequency with which articles are starting to talk about blockchain technology. It's so profound that by the middle of 2016, it's gone from being about 10% of the corpus to 25% of the corpus. Okay. So again, I just want to emphasize that the future of Bitcoin and cryptocurrency remains to be written, and that this is just a snapshot that provides one small window into the social dynamics that are currently playing out around it. But from what we can see here already, though, there are definitely some indications both in terms of where material resources are flowing and how we're collectively talking about and understanding cryptocurrency that are really indicating that cryptocurrency's identity as a blockchain technology is currently more strongly favored to carry forward into the future than that as a payment system. All right, so just summarizing up this past part, I've hopefully been able to show you that different audiences' ability to define Bitcoin and cryptocurrency differently through time has actually been really important to its widespread adoption. But now that it's facing a lot of pressures to narrow down that definition, we can start seeing where it's headed. And these indicators are less supportive of it becoming that revolutionary money it was hoping to become, or even a major disruption to existing payment and banking systems, and more supportive of a version of cryptocurrency that provides a store of value and a new technological basis for decentralized applications. So, concluding thoughts, one slide. If nothing else, I hope today that this has illuminated how much cryptocurrency and Bitcoin has reminded us about the fundamentally social nature of economic value. I hope that you are kind of more convinced now that socially constructive value does not mean inherently unstable value, though I'm going to put a caveat on that. I'm not saying it's stable inherently either, so don't go put all your money in Bitcoin, on my word. And then also that the rise and future of cryptocurrency has not just been a matter of the underlying technology, but also how people have made sense of what that technology means and why it has worth. So even briefer summary, I hope that after this talk, Bitcoin is a little bit less of a magic internet money and maybe a little bit more of a socially constructed one. Thank you.
Just
Yep,
take
yep.
up a question.
Go.
Thank you very much. I think it was very well researched and it was very informative, so really appreciate it. I'm based in South Korea right now. Obviously, Bitcoin, 1/5 of all Bitcoins are traded there. And Bitcoins are traded at 40% premiums to in the US, okay? Now, a couple of things happened. I wanted to get your thoughts on Weiss, the independent credit agency, just recently was the first credit agency to start, rating cryptocurrencies, right? So they gave Bitcoin a B minus. They gave Ethereum a B. I personally think that they're, from a business perspective, playing the, early bird, get ahead of the curve game. So it's a new line of business. I don't necessarily think that there's enough data for them to do this. And I don't understand the metrics, how they come up with these things. Do you have any thoughts on that, on Weiss and their ratings and the metrics and how on earth they can figure these things out? Say this is B minus, B plus, or B. I mean, I think it's premature, and I don't see the metrics. I don't think there's enough data to do this. So what is it? What are your thoughts?
So I'm not deeply familiar with this particular instance, but I will say that this issue of metrics and the evaluation, especially of financial objects, is a big area of research in economic sociology. So this is a process that's called commensuration, which is how you take qualitative features and you turn them into very neat metrics. When it comes to something that's still working out its definition, deciding what to evaluate upon, which features matter most to it, is a really tricky business. So this actually, though, was like a big player in the housing bubble, for instance, right? We got into this very collective notion on how to evaluate things, which began decoupling from the underlying processes going on. So I would say that, yes, it might be premature to think that you could really slap a grade that succinctly on cryptocurrency, because collectively we're still figuring it out. That said, it is the nature of a lot of these social dynamics that if you start a standard, then things will start conforming to that standard. So by going in and deciding that these are going to be the metrics, what you would expect to happen is that people working in that space will try to orient themselves to it, for better or for worse.
Well, I'm a Wall Street guy for a long time, so I know that if you take a bullish stance or you take a bearish stance and you're early in the curve, you'll be eventually right.
Yeah.
Okay?
Yeah.
So do you make it happen?
If men define situations as real, they can be real in their consequences.
And I'm sure everyone was familiar how there were 100,000 hackers. One or two may have been Korean to try to stop them from coming out with it. Who knows for sure? But it did have an impact on it had a significant, a meaningful impact on Bitcoin prices, right? Now the second question, Korea is now coming in, and one of the tremendous values of crypto to me is anonymity. And now they want to regulate
Yep.
in Korea,
Yep.
and now you have to register tax ID, this, and that.
Yep.
And that will obviously set a precedent for other countries to follow, okay? What is the impact to that? Bitcoin, have you looked at that?
So I haven't looked at that particularly. So what he's referring to is that South Korea, you might have heard, over the past month has taken a very, one might say, a more hostile or conservative stance toward cryptocurrency. They've backed off of that a little bit, but what they're basically asking for now is, in order to participate in cryptocurrency exchanges, they want more information about the individual. So they want to get at that anonymity. So you can see there, the government, this is a functionality of Bitcoin and cryptocurrency that was designed specifically to work around central bodies, right? As to what it's going to affect cryptocurrency, it depends on what you think cryptocurrency is good for, okay? So if you think that the main use of cryptocurrency is to facilitate anonymity in interactions or transactions, this is going to be very bad. If you think it's supposed to be just the basis of a blockchain technology, it's not as big a deal. So what's happening right now, there are a lot of different groups with a lot of different views of what cryptocurrency should be that are currently duking it out. And that's that narrowing of the definition that's having to happen right now.
One more question. Sorry to monopolize because I have to get going soon. The thing that if there was any gap, I thought your presentation was fairly comprehensive, but there was a gap, I would be talking about that the uses, for instance, let's talk about Haiti, right?
Mm-hmm.
That was the only time when banks were where everyone could contribute less than $1.
Yep.
You could donate 5
Yep.
cents to Haiti,
Yep, yep,
and the
yep.
bank would not
Yep.
take anything.
Right.
Happened once. You could donate $1 and they wouldn't take any fees.
Right, right.
So which proves that the banks can do this if they
Right,
want
right,
to,
right.
right? Now, I think there's a tremendous value for cryptocurrencies, particularly in countries like Zimbabwe
Yep.
and all these
Yes.
countries, Haiti, that are failed states.
Mm-hmm.
Failed states where the currencies really
Yep.
is basically, might as well, toilet paper, okay?
Mm-hmm.
And the divisible nature of it, that it can be, as low as you want. And in Africa, people are had this become, cryptocurrencies, particularly Bitcoin, have become de facto, or have replaced the currencies. And I think that's a very, very
Yep.
important role now and in the future. It's a great social equalizer for the Venezuelas and the Zimbabwe's of the
Yep.
world. And I think that wasn't mentioned in there.
No,
I think
is-
it's a tremendously important
It
area.
is something, yeah, so time constraints, right? It is something I actually do bring up with the papers that this work is based upon. And it is something which generally can relate to this notion of a store of value, et cetera, but, and is something that is definitely a lot more in line with that original founding vision. Again, though, you can see why governments don't like that idea.
Right. And then the final point is this. I think I think the Bitcoin, this is the last question, I'll pass on. The Bitcoin thing, I think that we're going to get pushback, you're already seeing, is from the environmental movement, right?
Yes, that is a very big deal.
To me, it seems that is the biggest flaw of Bitcoin, is the mining aspect.
Yep.
And where people go to Iceland and they go anywhere they
Yep.
think that they can mine and get electricity prices cheaper. Now, this has consequences for the local community.
Yep.
Right, where they use up all the electric capacity utilization, they take up all the capacity, prices go up, it affects everybody in the community. And then, just like they did in Flint, Michigan with GM, then they move on to the next place, and then you're screwed. So I think that this is not sustainable. I think it's environmentally unsound, and I think this is the single greatest flaw of Bitcoin.
So I would say you're not alone in that.
I think it's ridiculous. I think it's a stupid model, actually. So I'm a big fan of blockchain, and I think Bitcoin is obviously the biggest one. So you have to do diversification theory. So you put some in your portfolio.
Sure, yeah.
But who knows if Bitcoin will be around 10, 20 years from now?
Sure,
We,
yeah.
it's like the internet. So yeah, you put a little bit in it, but. I think that environmental thing that really puts a discount. You have to discount that factor into the Bitcoin model.
I will say it is a big problem, no doubt.
I'm going to ask the next question very quickly.
Yep.
How do you mine a Bitcoin?
Well, Charlie.
Where do I get a shovel?
Where do you, well, Charlie, I've got this slide right here. This is not, so you need, at this point in time, if you want to mine a Bitcoin, you need a really powerful rig. to do it. So yeah, a computer, right? So up to including they have, for instance, a lot of people use things called ASIC, which are application-specific integrated circuits. These are circuits that are built just for mining Bitcoin. So something about the Bitcoin network is that it has this really initially ingenious design that the more computational power that's being thrown onto the network, the more difficult the cryptography becomes in order to make sure that somebody can't just show up with all of Google and circumvent the network's verification process, right? So when it started out, people were running this off of their personal computers. At this point in time, it is a major financial investment to set up a Bitcoin rig. And as he was mentioning, the power draw on it is absolutely obscene. But just, what mining basically is there is a transaction that occurs. It's bundled with other transactions that have just occurred into a block. This is sent out to the Bitcoin payment system. Miners then compete to verify and add that block of transactions to the existing record, which is the blockchain, right? So it might be a little late, Charlie. I'm sorry, unless you just want to really. You could do some venture capital raising, though.
No, but I just to understand what the effort,
right.
What's the actions?
So the action, and so this is an argument. So the original Bitcoin exchange rate was priced as the amount of electricity it took at that point in time, the cost to do one Bitcoin, right? That is no longer how it is priced. So the power that is going into to mining, the only work it's currently doing is to verify the Bitcoin network, right? Does that make sense? Yeah.
Hey, Lynette, thanks for this talk. This was actually wonderful to see all the various components and kind of, various data aspects as well. Super useful for myself as a PhD student. And I'm also wondering, have there been similar historical narratives of other currencies? I'm thinking of the US dollar in terms of and how does that mine over to kind of cryptocurrency narratives that we're seeing?
Yeah, so there's actually a really good piece in sociology called The Color of Money, which breaks down what happened. So with the Civil War, America briefly went off of the gold standard and was just doing government-backed certificates. And then after the Civil War, there was a huge debate on whether or not to go back to the gold standard or a silver standard and that. And in that moment, you actually see this explosion of pamphlets and discourse on what the nature of value is, right? Then we see this drilling into right there. So this is not unprecedented, right? So somebody else mentioned tulips. So there's another notion that what we're seeing here is not a convention arising around something's worth. What we're seeing is the bubble, and that's what I was trying to address with that earlier part, essentially. So, but yeah, there's been various iterations of this through time. Even the institution of gold as currency started back with the Roman Empire, right? That was a decision that was made, and there was conversation around it at that time. Yeah.
So I'm also from South Korea, but my question is not.
You guys got a lot going on right now.
But more about the computational model. So it seems like you're using the computational model to sort of suggest that the value of Bitcoin has a social origin. And you're basically using this social influence kind of process to show that the value sort of, reaches this sort of, equilibrium.
Is capable of stabilization.
Right.
Yeah.
I kind of like that approach, but when I think about it again, it seems like the pattern that you find in your model does not coincide with what we actually see empirically. Right. So the value of Bitcoin is like fluctuating.
Right. So this is that preliminary work I was talking about. So just because we have a convention doesn't mean that bubbles don't also happen on top of that. Does that make sense? So what we can do here is start thinking about how if there's a conventional value that has stabilized, how on top of that there can be these animal spirits, for instance, to use Keynes's term, that take over and suddenly everybody thinks it's going to be worth a lot at some point in time, or everybody thinks it's actually undervalued and now it's valued more. The interesting thing about social convention, right? So this is, percent up may be a vaguely reflective of people willing to buy Bitcoin at a given time. So we can induce a bubble to sort of say either, and this is actually becomes a fine distinction, do you act as if you think it's more valuable, or do you briefly believe that it's more valuable? Okay, and see how that affects the system. What that ends up doing is that we do get that spike because I've induced a bubble. But when the bubble goes away, the price drops back down, but it's not as low as where it started. This is actually a ratcheting effect. And that is something that you find in Bitcoin's price. Does that make sense? So it'll have a big run up, it'll drop, but where it drops back down. You'll note also the timing matters a lot. So early on, if you have this sort of bubble, its ability to affect the worth is much greater than if you have it later on, because we can start really thinking about that social value as being a function or dependent upon memory, essentially. So how long is the memory for it? But that's a great question. I feel like it is very important. And again, I'm not saying Bitcoin is here to stay forever, go buy some right now. So just that caveat. Thank you, that's great.
So, I can, so I actually had a question that I guess would tie maybe nicely into this one, which is just the scarcity, right?
Yep.
The finite amount.
Yep, yep.
And how that, within the constraints and obviously kind of this growing network effect and increased adoption,
Yep.
right, plays into this game.
Right,
And,
right.
I'm seeing a lot of different forces. You mentioned agents, right?
Yep,
and
yep.
How dominant they might be.
Yep, yep,
We're
yep.
seeing more and more agents come up and either
Assert.
for or against Bitcoin.
Yep,
but-
yep.
But so I was wondering if you have any insight into that.
To the scarcity.
And again, like on the other hand, the forces that are kind of pushing the hype, right, and
Yep,
creating more
yep.
of that story.
Yep,
to
yep, yep.
increase the value over time.
Right.
Is that the trend? Is that where you see things going?
So, okay, so just a couple of things. So the scarcity thing, which is specifically relevant for Bitcoin, so if folks don't know, Bitcoin is programmed to have a cutoff after which no more Bitcoins will be mined. I don't think that is necessarily the primary dynamic going on right now, because we're still in the process of creating new Bitcoins. There's not a for sure scarcity yet, right? That said, the future.
Very small amount.
Right, sure. And so that future, so the reason that they wanted that scarcity was because they wanted a deflationary currency.
Right.
And so on first principles, if Bitcoin continues to have value and then the supply is limited and we've all settled in our convention, then I would expect it to act in very similar to the price, like the demand supply dynamic you would expect if that convention of valuation has been established pretty well. Does that make sense? So in terms of personalities showing up, I think that this is something that has been, in terms of folk knowledge, in terms of how to, for instance, get a high public offering when you first come out with your company. Hype has something to do with it, right? So hype, right there. The question, though, is your hype making claims about a physical reality that are not plausible? That becomes a lot more brittle than these other processes of social influence, where if you can get people in early and say, we're going to buy into this right there. So are you familiar with like the path dependency work that's been done on VHS versus Betamax? So VHS realized early on that if they just subsidized people, made it easier for them to get VHS early on, later on, everybody would adopt that. Betamax would be driven out, and then after that they would have more profits. So I think it's pretty well established folk knowledge, and it's definitely in a lot of sociology. I don't know how often it gets transported over into economics about how this can actually have real long-term consequences for value. Hopefully, does that address kind of?
It does, but again,
Yeah.
there are all these different, I guess, out of your research, and you
Yeah.
would probably have the best kind of insights.
Yeah.
I'm wondering, so we're seeing a bubble, we're seeing it pop, we're seeing it,
Ratchet, yeah.
Yeah, a little bit higher, and we have even
Yeah,
seen this.
that's
whatever,
since its beginning,
2009,
yeah,
right?
yeah.
So based on that, would you expect that to kind of continue happening?
I think it has. I think the longer a convention is in place, the more stable it becomes, right? So,
Doing that work?
right. Well, I mean, we can think about this in terms of, for instance, the price of gold, right? So oftentimes the argument for why gold has value and is not a bubble is because it has an intrinsic utility, ultimately, for tooth fillings or industrial applications. So that's the story. The convention, however, that has been sitting on top of gold for thousands of years is that it's worth more than that. And a big part of why gold is considered valuable is because I can reliably expect other people to also find it valuable, right? And when it comes to money or liquidity in general, the key part there is the reliability of the expectation that everyone else is going to value something at the same time. So that is a self-reinforcing dynamic, which is capable of stability. It can also be disrupted. So, but I will say that the longer that Bitcoin holds value, the longer it is more likely to hold value in the future.
Okay. This will be the last question, okay?
So you showed that the general trend is, or recently has been more towards the blockchain technology. What are some examples of like using the distributed nature of blockchain for like non-medium of exchange usages?
Okay,
Or
great.
what are
So
those?
we can think about, for instance, contract verification, right? So usually I need a third party there to negotiate between the two parties or the multiple parties in a contract. What you can do with a blockchain application is essentially set up the deal from the get-go and have the algorithm, basically have that algorithmically mediated. So it says all parties at this point in time will need to apply their signature, otherwise we're going to revert and everybody gets their original money back. And you can do that for a very long time. How that creates efficiencies in existing applications is I now no longer have to hire a third party to handle that. I can just build my own application and let that there. So a lot of things, we can also think about securities exchanges, for instance. So handling those, this can be handled very rapidly on a blockchain. And again, I'm not having to rely on a third-party intermediary who I trust, and I'm paying a lot of money, a premium, because I want to be able to trust them. Does that make sense? Great question.
Is that all?
Okay. Cool.
Well, look, let's thank Lynette again.